that's the entire farm. You can't go crop by crop. If you elect to go individual ARC, then all crops on that farm are in it. And oh, by the way, any other farm in the state that you have interest in that is elected into individual ARC now becomes all one big farm. And so you're going to calculate a revenue benchmark and a revenue guarantee on all crops on all of those farms. And in some ways, when I look at that, I'm not sure that fits our country too well. If you're spread out, you've got a number of farms, and you all went into individual ARC on all of those, if one farm gets hailed out and the others don't, it probably won't qualify for a payment because the production and revenue from the other farms may knock you out of a payment. So that's something to look at, and it's important to note that PLC and county ARC are crop by crop, but individual ARC is the entire farm and all farms that go into ARC in the state for which you have an interest. You know, Jenny covered this, price loss, the payment occurs anytime that 12-month national average price drops below the reference price, and the effective price is just the higher of that 12-month average price of the national loan rate for the crop. So really the national loan rate's the floor. It can't go any lower than that. Payment rate equals the difference between reference and the effective price. You know, the other thing is when we look at calculating payments, there's an 85% base factor on PLC and county ARC. There's a 65% factor in calculating payments on individual ARC. So you got to make up that difference just before you know, you're even with county ARC or PLC. This is the chart we looked at. I'm going to skip this example because we're going to get into a little different example in some detail here. Jenny covered the disaster programs, don't have cotton. Just a comment here, payment limitation, let's take a look at it because it has changed at least the limits by program. It applies to each person or entity. FSA does not recognize a general partnership. But a general partnership or joint ventures will look through. So they look to the members themselves in determining how many payment limits. Payments made to an entity such as a corp, limited partnership, limited liability company, trust, or estate itself has one limit, as well as all the owners and individuals have one limit. But there's also attribution, and we'll look at that here in a little bit too. Spouses qualify as separate persons as they have in the past. The dairy margin program is not subject to payment limitation. So we've got 125,000 limit. Well, that's up significantly from the 40,000 we had. So 125 per person on PLC ARC, marketing loan gains or LDPs. CSP 2014 through 2018 is 200,000. You know, one thing to watch for in CSP is in the past we've had not only a 200,000 limitation, we also had a 40,000 limitation per year. The act itself doesn't talk about the 40,000 annual limitation. So I don't know if that's a change. Hopefully that'll be clarified in the final rules. But check with your NRCS, they'll be able to answer that question for you down the road. EQIP is 450,000. NAP has 125,000 limitation. The supplemental program Jenny talked about is 125, and then the tree assistance program has a separate 125,000. The AMA program administered by NRCS also has a 50,000 limitation. Actively engaged, and you've heard me talk about for years, since 1989, what it takes to be actively engaged in farming. You know, doesn't do any good to make the right PLC and ARC elections if you don't qualify for payment. And so when we talk about payment limitation, we're talking about being actively engaged, meeting the cash rent tenant, and so forth. One of the changes that came about in the Farm Bill, the Secretary has 180 days to define limitations where individuals qualify through management alone. If you think about the formula, you know, you've got left hand, it's land, capital, equipment. You got to have one or more of those contributions. One left hand contribution or more. Right hand is active personal labor, active personal management. If you're not providing labor, you're only providing management, there's going to be some limitations on how many persons can qualify through management alone. The good news is, one, it doesn't apply to family members. So if you have a partnership and you've got, say, a son and daughter involved, but the son is he's in college, he's about to finish his last year, but he is involved in the operation, he comes back and helps out, but his primary contribution is management, it won't apply to him because he's a related family member. And it doesn't, and this provision won't take effect until 2015. But anyway, we do need to watch the announcement, the final regs, see what the Secretary does with that option. Adjusted gross income has changed just a little bit. They no longer look at farm income and non-farm income separately. You know, before we had a 500,000 or less farm income to qualify, or 750,000 non-farm. Now it's all lumped together, and now it's down from 1.25 down to 900,000. In some ways that may help. The problem that a lot of producers, or some producers had, it wasn't with the farm income, because if you've got a good accountant, you work with your accountant, you've got some means to adjust your farm income, but your non-farm income is what caused problems. And now, you know, now that if you can adjust your farm income, now it's 900,000 for the combined. It still skips the previous year, so for 2014 we're going to be looking at 12, 11, and 10. Those, the average for those 3 years. So check with your accountant. They can help you. They can go back and look at your tax returns and help you with whether or not you qualify under AGI. AGI applies to all Title I, PLC ARC, and disaster, marketing loan gains, LDPs, under price support. Apply to Title II conservation programs beginning in 2015. Talk just a little bit about AGI because there has been some confusion on how AGI works around multi-year contracts. If you apply for CRP and you're approved, then, and it's a 10-year contract, and the year that you apply and the contract's approved is the year they look at AGI. If you qualify in the year the contract's approved, they never look at that again for the remaining 10 years, even if you get out of compliance later on or you exceed the limitation. The exception to that is if there's a change in ownership, say you're operating through a partnership or corporation, if there's a change in ownership, then the new people coming on board would have to recertify because they hadn't filed a certification. And they'll look at it again if there's one of those changes. Otherwise, FSA will not go back to prior year contracts and look at it. But any new multi-year contracts or any conservation programs beginning in 2015 will be subject to the 900,000. There will be a new CCC 941 certification form beginning this year because of the change in dollar amounts. And no, oh, by the way, you know, just like, you know, I'm going to talk here in a minute about, and Lee did too, about subsidized crop insurance being subject to HEL and wetlands. So when you certify your AD on your AD 1026, that you're in compliance with HE and wetland, your crop insurance agent will probably get a copy of that because you do have to be in compliance. So anyway, new 941, and direct payment attribution. Just briefly mention that. Remember, individuals have a limitation, so don't entities. But if payments are made to an entity, then they're further attributed to the actual owners. Entities are subject to one limitation. Payments earned individually plus whatever may be attributed through ownership in other companies also applies towards their individual limitation. An example here, we have Dad farms, and he has farming interests in Corporation A with son 1, Corporation B with son 2, and then he farms as a sole proprietor also. We can see that $80,000 worth of payments are in Corp A, and $40,000 of that's attributed to Dad and $40,000 to son 1. In Corporation 2, that's what attribution means. They're attributing the payment earned by the entity on down to the owners. Same way in Corporation B, Dad gets $50,000, son 2 gets $50,000. Or 40, let's see, it's 80, 100,000, yeah, so 50 goes to Dad, 50 goes to son. Under Dad's individual operation, he earns 80,000. All of that's attributed to him, so we can see that Dad, both what he earns individually and what's attributed to him through those two companies, puts him at 170,000. What did I say the limit was on PLC and R? It's 125. So he's going to be over the limit. He very well could lose $45,000. But maybe Dad looks at this and says, you know, I've just been signed up myself with FSA, but geez, my wife, she'd been involved in the operation. She signs the operating note, same as I do. And so maybe I should add her. So if she's added to his individual farming operation, now instead of losing $45,000, we went from 125 to 250 because now we got 2 payment limits. So it's something to think about. You know, I said earlier, look at your operation, the way you're structured and who's involved. You may want to change that a little bit.
What was the date on that again? That they used?
June 1st is the status date of 14. So they'll look at the way you're structured as of June 1st of this year. Even though sign up may not happen until next January or February, they're going to look at the way you're structured this year, and as of June 1st, then that determines how they're going to distribute payments through those entities. You've all heard me talk for years about actively engaged. I've talked about this left and right hand. In addition to having a left hand and a right hand, you have to be at risk, meaning a landowner that cash rents ground or guaranteed bushel lease, not at risk, doesn't qualify for payment. Even if the lease agreement says that, and I've seen some of those, where the lease agreement says, well, the landowner gets a third of the crop farm program payments. If the landowner's not at risk, I don't care what the contract says, landowner doesn't qualify for payment. So you got to be at risk, you have to be commensurate. Commensurability really just means that if you're in a joint operation and there's 2 or more individuals, the way that those individuals in that joint operation are contributing land, capital, equipment, labor, and management, that has to be commensurate with the sharing of profits and losses in the business. So if you're in a general partnership, you know, we help a lot of producers with FSA end of year reviews. And one of the things we always look at in a general partnership is the K1s. The K1s better match up. In other words, if you got 3 people each owning a third of that partnership, then the K1 should distribute any profit or loss, whichever the case, 1/3 to each member. If it doesn't, you may have a problem with FSA. IRS lets you distribute it however the members agree to, but FSA says you have to be commensurate. So consider that, that's a key issue in eligibility. Watch this management thing that Secretary will clarify. Cash rent tenant rule. You know, I've done a lot of seminars since 1989, and I always talk about the cash rent tenant rule. It's probably the most violated rule of all the payment limitation. It's probably caused a greater loss of payments than any other payment limitation provision I know of. In fact, in the early years, Congress actually granted some exceptions for 2 or 3 years just because it wasn't well understood. But so how do you meet the cash rent tenant rule? And this is in addition to being actively engaged. To meet the cash rent tenant rule, an individual or entity, as the case may be, must contribute a significant amount of active personal labor, active meaning it's not hired on your behalf, you have to do it, or management and equipment. And you've got to do one or the other. And if it's all being custom farmed, then FSA is going to consider that the labor and the equipment's being provided by the custom operator. On cash rented ground, hiring all farming operations completed violates the cash rent tenant rule. A producer may not cash rent ground and sublet ground. That's another area. If you cash rent ground, turn around and sublet that on a share rent basis, you would not qualify on that share rented basis because if it's all custom farm. In both cases, the labor and equipment is considered contributed by the custom farmer. Cash rent tenant rule never applies to own ground. If you own ground and you're the tenant, it doesn't apply. If you share rent ground and you have hired all custom farm, that's okay, it doesn't apply. It only applies on cash rented ground. Now watch some of these leases where if FSA deems the lease to be cash rent, it's subject to the cash rent tenant provision. Some custom operations may be performed which are considered normally custom hired. A little bit about CRP. Lee mentioned that we're dropping from 32 million acres down to 24 million. In addition to that 24 million, 2 million acres kind of been earmarked for grassland in our CRP in areas historically dominated by grasslands. CSP, we've talked about that. It's funded. Secretary shall enroll 10 million acres each year for the next 5 years. So if you're not participating in CSP, I'll take a pretty hard look at it. There's some pretty decent payments that you might qualify for. Make the program available to producers on a continuous enrollment basis, and one or more ranking periods, and one which shall occur in the first quarter of each year. EQIP is funded and still available for producers. And then the reference to HEL and wetlands with regard to the crop insurance is the first time we've ever seen this. I mentioned as you certify on your AD 1026, that's probably going to have to go over to your crop insurance agent. If you've never participated with FSA and you've never been subject to HEL or wetlands, the Act says that you'll be given 5 years to get with NRCS and develop a plan and get into compliance. Now, I'm not sure, we need some clarification about what that means. So if I've never operated and I buy a farm that did have a conservation plan, do I have 5 years to get in compliance? I don't know. We need to watch the federal regs to clarify that provision. But if you do have a conservation plan, you are in compliance and you get out of compliance, it's a little bit different. FSA says anytime during the crop year, if you get out of compliance in 2014, you lose 2014 payments. This says, the Act says, with regard to crop insurance, that the year you're determined out of compliance does not impact that year's payments, but the subsequent payments. So it may give you some additional time to get back into compliance. So anyway, we need some clarification on that. It's certainly a big change with regard to HEL and wetland provision. SCO, we've talked some about that. I think it'll be available on wheat this fall, unless you later elect into ARC. How should producers prepare for decisions? I'm going to save that for a little bit. Now I'd like to go to the handout on that farm example. Okay, this first example, we're going to take a look at this farm 101. It's got 1,000 acres of cropland, 500 acres of wheat base, 300 acres of corn base, 100 acres of sorghum, for a total of 900 acres of base. Base has not been updated since 1985, but the actual planting acres of these crops are not representative of current crop base acres, at least not what was compared to what was planted in 2009 through 12. And this again relates back to that base reallocation worksheet I handed out. So we're going to take a look at those crops. We're going to take a look at the 4-year average plantings of each of those crops. And we're going to develop a factor. So in the case of wheat, we had 150 acres, and the total acres that were planted was 1,000. It gives us a factor of 15. Corn, we've got a factor of 6625, and sorghum 1875. So we take those factors and we apply it to the base that's in effect as of October 1 of 2013. So that is the base unless you reallocate. So we take the 900 acres, apply the factor, and we can see that wheat went from 500 acres to 135. We almost doubled the corn base, went from 300 to 596. And on sorghum, we went from 100 acres up to 168 acres. So that's how that base reallocation works. And something you sure want to take a look at.
I have a question.
Yeah.
Suppose you didn't plant sorghum anymore, you can't reallocate that to corn.
You didn't plant sorghum, you would have no allocation factor. Now, right, because we're going to look at the sorghum acres that are planted, and so in 2009 through 12, if you didn't plant sorghum, there'll be no factor for sorghum. So I mean, you still might have a sorghum base.
But you can't reallocate it to something you are planting.
Yeah, well, let's see, let me think about that. So, yeah, you can, because if you planted, let's say, corn and soybeans, that's what we're going to look at, and that's the factor we're going to establish for that 4-year period. So, let's say you planted half corn, half soybeans. So your factor would be 50-50. So now you take that 50-50 and you go back to your actual 900 acres, and it would all be corn and soybeans. So yeah, you can. Because it looks at what's planted in that 4-year period and establishes a factor, and that'd be 50-50 corn and 50% soybeans. And you take that factor then back to your 900 acres of base, and that would be your base. So it'd be split half and half corn and soybeans. Yeah. Okay, let's take a look at this yield update. So any producer yield in prior 5 years that falls 75% below below 75% of the county average yield would be a plug yield. And so that's why I handed out that sheet, because you got to access NASS data and find out what those county average yields are. But anyway, in this wasn't specific to a county, so I didn't calculate a plug yield, but I took 3 crops, wheat, corn, and sorghum on this farm 101, and took a look at what my actual production was during that 5-year period. And then if you take a 5-year total and average that, and then take that times 90%, and then compare that against your 2013 yield, then you would know whether or not you want to update yields. And you can have this really figured out before, FSA, down the road here is going to announce a sign-up period. But again, look at, go to your crop insurance agent, get your production. Now that may have to be adjusted a little bit on a farm-by-farm FSA farm basis, because this is by FSA farm number, and sometimes your crop insurance units don't match up with FSA farm numbers. So you may have to recalculate the production on the FSA farm number. But you can go ahead and do this. There's no reason that you can't go ahead and calculate this and have this available. Linda, would you give me a copy of that handout, maybe out of another packet?
What's the 90% on that one?
90%, yeah, once you calculate the average, you take 90% of it, and that becomes the adjusted.
That's just a number
That's in the statute, yeah. So that's how the base reallocation yield update works. Let's take a look at the analysis of the PLC option. PLC is really pretty straightforward. What I've done is I went in mid-February and I pulled from ERS, I pulled down their projected prices. And we can see, and they're not that high by now. Later in February, they changed their estimate. And this is going to be continuous. I mean, Papler's going to do it. All those that project prices continually will be updating those. But anyway, this is what this was their ERS projections in mid-February. So we take the reference price and we compare it to the projected 2014 national average price. So wheat was $5.50 and corn, wheat at that time was projected to be $4.90. That calculates out to be a 60-cent difference. Corn $3.70 to $3.65, so that was 5 cents, and sorghum 55 cents. And I went ahead and showed what their projections were through the remaining years, but this example only looks at 2014. Now in the real world, when you sit down and do the analysis, you can't look at 1 year, you're going to look at 5 years. But just for illustration purposes, I thought, well, let's take 1 year and work through a farm example. So once we've got the payment rates, the next piece of that then is, well, let's calculate.
Now, are these reference prices set already? This is
Reference prices are locked in by statute.
So this is what we're going on.
Right. Yeah, these reference prices will not change. So then if you go over on page 3, then we take, once we've got the payment rate, then we simply go to our base acres. In this case, you know, we reallocated bases. So we use the base factor of 85%. So we take 135 acres of base on wheat times the 85% factor. We increased our yield to 33.1, payment rate 60 cents. So the payment on wheat's $22.78.94. We do that for corn and we do that for sorghum, and we come up with a farm PLC payment of $95.09.98. Now, what do we calculate? I mean, we know that we're going to compare crop by crop PLC against county ARC. Why do we need the farm total as well? Because in the analysis process, we also have to compare this against individual ARC. And so that looks at total farm revenue. So we calculate each individual payment, and we also calculate the total payment for the farm, and we'll use that a little later down the road. So that's pretty straightforward. That's easy. PLC is not hard to understand. So let's take a look at an analysis now on county ARC. So now we're talking revenue. We talk PLC, we strictly talk price. You know, it's like the old deficiency payments. I mean, a lot of you guys in here remember the old deficiency payments. If I remember them, I know some of you do. Same concept. Anytime the national average price dropped below the target price back then, there was a deficiency payment made. And that's the concept under PLC, strictly price driven. But with regard to ARC, now that's revenue driven. That's like the acre program was.
Right.
You know, one of the problems with the acre program that nobody liked was